Our next guest says investors aren't crazy. No, instead, he is a proponent of these complex debt instruments and is happy to see them return to the market. He is Randy Schwimmer, Senior Managing Director at Churchill Financial. Churchill does handle middle market origination asset management, currently managing $3.25 billion. Randy, great to see you.
Great to see you.
So have we seen the return to the CLO yet?
It's sort of like an Elvis sighting, Lori. We've seen some. It's not quite reality. There are a lot of proposals out there, but the mood is a lot better than it was 9 months ago.
The mood, but is the confidence in these a lot better? Are they a lot safer? Because when I was reading the story and heard of this morning, the first thing, as you know, that comes to mind is, oh my gosh, this is what led us into the crisis in the first place.
Correct, and people confuse CLOs with the other securitized assets that got us into trouble.
Meaning the mortgage-backed.
Subprime mortgages, CMBS, and so forth. CLOs, it's an interesting fact that no investor has ever lost money in a TripleA tranche of a CLO. But because the rating agencies have punished these vehicles over the last couple of years, the TripleA investor doesn't believe that they have TripleA.
Well, right, because they're giving TripleA ratings right to the mortgage, the subprime mortgage-backed.
Correct, and of course those got washed away. Now we're looking at the rating agencies having sustained most of the ratings for the AAAs now and saying, okay, the worst is over, so investors in AAA can feel a lot more confident.
So what specifically are they securitizing?
Well, they're securitizing loans as collateral, so
like
middle market loans, large cap loans, mostly commercial loans to large and mid-sized companies, very similar to what Churchill does.
Got it. Okay, so for the average investor, what's the best way to take advantage here? Because you're very optimistic. How, can you trust the rating agencies at this point?
You can trust the rating agencies. I think mostly because we've been through the worst. Both Moody's and S&P have revised downward their default expectations. Moody's, I think, is at 4% for next year. So the high water mark has been crested. The investors who are in those vehicles now feel comfortable, which is why we're starting to hear rumors. We haven't seen the reality yet, but we're seeing some proposals floating around for new CLO vehicles with equity, AAA tranches, and the same kinds of structures that we had, but we haven't seen the reality of it yet, and we're hopeful that we're going to see that.
So is there any concern when you say that these are commercial loans? You know, there's a lot of concern about the commercial real estate market crashing out. So with a 4% default forecast, it seems a little
what's interesting is even with the CMBS market, we're starting to see a little bit more talk about, in fact, I think Prudential was out the other day saying that prices in CMBS were improving. So I think what's happening is it's a combination of the fundamental economy doing better, asset prices rising. We've seen corporate issuance up, I mean, dramatically, especially in high yield this year. So the only thing that really hasn't happened is that the securitization market in CLOs hasn't come back the way it was. It was, I think there's $400 billion of CLOs out there now. I think JP Morgan is expecting $5 billion, give or take, next year, which is anemic relative to what it used to be. But I think that the level of confidence is back now. So it's only a matter of time before some of these vehicles actually become reality.
And as you know, part of the troubles was that these things were sliced and diced and passed on and passed on and passed on. So has that changed, that aspect of this market?
Well, I think what people are looking at right now are more sort of balance sheet CLOs, where the arrangers such as JP Morgan and Wells Fargo, which is a supporter of us, and Texas and other providers who are working with us and others to look at long-term solutions, are saying the worst case for loan defaults has been in the single-digit range, maybe high single digits for middle market loans for us, for example. That pretty much is over. We're seeing improvement next year. The rating agencies have supported that. So the value in those assets is significantly better than value in other assets, especially on the mortgage side that we've seen. So that's buttressing a lot of prices that we've seen in the last 9 months.
Randy, as you know, the big bank CEOs were at the White House yesterday being urged by the president to increase lending, especially in the mid-market level. Can these CLOs aid that?
We have been big supporters of that concept. In fact, our CEO has been to Washington and talked to the FDIC and others about that whole thing, because we are at Churchill and a number of others are big providers of middle market credit. We believe that this is the way that not only can create jobs, which is really critical, but also boosting the economy.
All right. Thank you so much. Randy Schwimmer of Churchill Financial talking about CLOs and their return to the marketplace. Many thanks again for your time.
Thank you.